year to date, the South African stock market is the second best performing stock market in the world.
Wow.
It's only Korea that has actually been better. South African stock market, despite all our challenges, despite all our many problems, has actually been the second best performing stock market in the world. And that, I think, is a key lesson for your investors to internalize, is that the economy is not necessarily the same thing as the stock market.
Guys, if you enjoyed this episode, please give us a thumbs up or a like, leave a comment, hit the bell icon. We really appreciate it, and it helps the channel very much. Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back to the Campus Dialogues, a Muslim Views production in affiliation with MuslimFin Family Office. MuslimFin Family Office, building trust, preserving wealth, empowering generations. I'm your host, Ali Sali, and we have a fantastic episode for you again this evening. So firstly, what we need to talk about is there are a few wars happening in the world, right? There's the price of gold skyrocketing, hitting all-time highs. Okay, it's come down a little bit. We have inflation. We have tensions between the great powers in the world. There's all of these things happening, but what does that mean for markets? Okay, and here to talk about that, we got our returning guest, our resident portfolio manager, CIO, Salih Salam. And here to introduce him, as always, my good friend and colleague, Siraj Music. Siraj.
Assalamu alaikum, Ali.
Wa alaikum salam wa rahmatullahi wa barakatuh. How are you?
Alhamdulillah, how are you doing?
Alhamdulillah.
Yeah, like I always say, another week, another podcast.
That's correct.
And like you said, tonight's conversation is going to be fascinating, because we're not just talking about tech, we're talking about money, markets, AI, the wars, and joining us is someone who's no stranger to our podcast. So a very warm welcome to Salih Salam. Salih, welcome back to our podcast.
Assalamu alaikum wa rahmatullahi wa barakatuh, and it's a lovely honor to be with you again.
Salih, like I mentioned, you've been here before numerous times, so we're quite happy to have you back. And I believe tonight you're going to give us a bit of a market update, and then we'll jump into some of the juiciest things that's happening around the world.
Inshallah, absolutely.
I'm going to hand over to you, and then you can just start with your present.
Yes, inshallah. What I'd like to talk to you and your listeners about for the first couple of minutes is maybe give you an overview as to how global markets and different asset classes have performed, let's call it for the year to date, if you will. We are now, we just started the month of December, as well as Jamad al-Akhir. So let's kind of take stock as to where we are. So for some of the key developments that took place in global markets, and in particular in South Africa over the month of November, which just passed, was actually, you would have seen that South Africa's credit rating, which is in a sense a sign of our, let's call it our willingness and our ability to pay our debts. That's what it's really, a credit rating, was upgraded in the month of November. That was quite significant, of course, because it's a good confidence boost for the country, as we'd say, the sovereign, in terms of our creditworthiness and our overall state of our balance sheet. So that was a really big deal. In addition to that, we had South African food inflation come down to around 3.9%, which is also good, of course. It just means that South African consumers and Muslims as well, of course, have got, inshallah, a little bit more real purchasing power in terms of the money in their pocket. As well, we know we are now pretty much on Umrah season, if you will. Lots of Muslims are going on Umrah. So the Rand, actually, over the last 3 months, has been the best performing currency over the last 3 months. So, inshallah, when all those Hajjis and Mu'tamirin are going to go on Umrah now shortly, inshallah, they'll have a little bit more purchasing power in their pockets, which is also a great blessing. In addition to that, on the global markets, what was also quite significant. There's a stock called Eli Lilly, which is one of the world's sort of leaders in terms of not only healthcare, but specifically weight loss drugs. And in fact, nowadays you go to the doctor, and the doctor sees you a little bit overweight. The doctor is quick to prescribe to you Mounjaro or trizepatide or any one of those other drugs. So Eli Lilly was the first healthcare stock to actually hit $1 trillion in terms of market cap.
Wow.
So clearly, those weight loss drugs are really good for those share prices. In addition to that, about more than a year ago, I told you guys about gold. To kind of load up on gold. What's also happened now is that silver, the shiny cousin as well, of course, of gold, has also hit a record high. So for the month of November, in fact, some of the best performing stocks on the JSE were actually your gold and your precious metal stocks. Anglo Gold was up 22%. Impala Platinum up 15%. Sibanye-Stillwater up 20%. And then, of course, other shares like MTN, Prosus, and Naspers were down anywhere between 9% and 12%, respectively. If we go on to the next slide, I think this is a really good slide, which think of this as a quilt, if you will. And what it really shows you is going back to 2010. What were some of the best performing stock markets over different time periods? And if you cast your eye on the last bottom row, right at the bottom, sort of the red block, the block that has been highlighted in red, what that indicates actually that year to date, the South African stock market is the second best performing stock market in the world.
Wow.
It's only Korea that has actually been better. South African stock market, despite all our challenges, despite all our many problems, has actually been the second best performing stock market in the world. And that, I think, is a key lesson for your investors to internalize, is that the economy is not necessarily the same thing as the stock market, right? And that's a really key point to understand. And in fact, there can frequently be divergences. In fact, quite significant divergences. If we go on to the next slide, what I'm showing you here is the top major sort of asset classes. And I just want you to focus on the last year. So this is the 1 year to the end of November 2025. You can see that the overall JSE has given you a return of 36%. MashaAllah, that is really, really, really good. South African bonds, which of course, from a Sharia compliant perspective, we don't invest in, but nevertheless, just as a proxy, has given you a return of 20%, which is also an absolutely tremendous return. Global stock markets, as proxied by the MSCI World, only gave you a return of 11%. Now that in and of itself is also quite a respectable return. But to put it into context, the South African stock market, you can see, essentially generated 3 times the return. 3 times the return of global markets. Global bonds was essentially flat to negative, and then the US dollar was quite weak over the time period, down 2%. If we now go on to the next slide, what we're showing you here is sort of like a deeper dive. We told you that the overall JSE gave you a return of around 36% for the year. But within that, the real action, if you will, the real action has been in resources, up 118%.
Amazing.
Absolutely amazing. Absolutely amazing. 118%, right? I think a 111 is what they call a Nelson in cricket, right?
I was just thinking of that.
I could see that, huh? Ali's a cricket player.
Yeah, that's right. It's a century.
So just a little bit more than a Nelson over the last year. Literally, precious metals and resources, they kind of hit the ball out of the park over the last year, and that lifted all the boats in the South African stock market, with the market giving a return of 36%. Even property gave you 31% return. Industrial shares 20%. Across the board, all these returns are highly respectable. But the standout, of course, in this context is the resources index, and that's basically brings me to the end of my market update. So key lesson from that: number one, I just want you to understand. Really, there's been a good environment for South African assets. Actually, the best, second best in the world. Despite our challenges, we've had a slew of really good news. Inflation coming down. We've had our credit rating improved. Our tax receipts and our fiscal position is looking better. And all of that has basically acted as a tailwind for the broader domestic economy. And at the same time, of course, the strength that we've seen in precious metals, which is gold and platinum, has caused the precious metal sector and in particular resources to do exceptionally well over the last year.
That's fantastic news, Salih. Great, and I mean, I'm sure that all South Africans and all of our audience watching this are saying to themselves, that's good news for South Africa, that's good news for us, that's good news for the Hujjaj, that's good news for everybody from a South African perspective. Some more good news that we've had recently was the G20 meeting in Johannesburg. There was some tension around that. And there was some, I guess the United States decided to boycott the G20 event. Donald Trump still continues to say that, you know, the white Afrikaners in South Africa are going through a genocide. So I'm not sure if he's ever been to South Africa. But, you know, so we're dealing with that type of tension, but the rest of the world seems to still want to do business with South Africa. With this type of, you know, tension with the United States still being the most powerful country from a military perspective in terms of hegemony, then also from a economic perspective, what does that do for South Africa, and in terms of South Africa's future, how will that affect, you know, the markets and the economy potentially?
Well, mashallah, that's quite a question. I think, as we also indicated on some of our previous podcast discussions, we are living in a sense a multi-generational sort of shift that's happening in the global, let's call it the global order, if you will. And that is affecting not only geopolitical sort of structures, but also relationships, as well as, in a sense, a change of the so-called, what is called previously the rules-based order. All of that is changing and is, in a sense, being renegotiated in real time as we speak. So it's that then means, of course, that everything is highly fluid, right? Very, very fluid, and that, of course, affects country-to-country relationships. It also affects geographical relationships, because you may have certain regional blocks that may also have a relationship with another regional block. That is all being renegotiated. That at the same time has then caused, of course, amongst others, it's been one of the reasons why gold has been so strong. Because in periods where the rule books are literally being rewritten, as firstly being torn up and then being rewritten as we speak, that acts as a tailwind for gold. In addition to that, I think amidst all this change, it is very, very easy to get lost in what is changing. And it's very, very easy to be almost potentially paralyzed by all these changes. But if you take the problem and you turn it on its head, as Charlie Munger says, you invert the problem.
Okay.
So instead of asking what is changing, ask what is not changing. What is not changing? So what's not changing is people still need good health care, right? People still want to have good education for their kids. People still want health and safety and security. People still want to travel, right? Whether that be on Hajj or Umrah or so on, right? People still want to communicate, okay? People still need housing. So when you focus on what are those essential, unchanging needs, right? It helps you to drown out the noise as to what is changing and ultimately what you can't really forecast because the rules are being, the ink isn't even dry on the rules, right? It's constantly being rewritten. So in the past, with people who talk about greenhouse gas emissions, now we have to think of White House emissions. Right? White House emissions. And how are you going to sort of insulate yourself against White House emissions? Okay. So, and that's why I'm saying focus on what is not changing. And try and find investment opportunities that are focused on solving real problems, that are focused on seeing to real needs that are timeless, that exist irrespective of geography, that exist irrespective of how the global rules order may or may not be redrawn. And that will help you to try and find, let's call it enduring value, right? Because as I said, when you focus on those enduring needs, ultimately you're going to find enduring value. And ultimately you're going to find opportunities for enduring wealth creation.
And absolutely, that's a great point, Salih. And what I'm hearing you say is that kind of focus on the fundamentals, right? Focus on the fundamentals. You are going to still be able to, within the noise, find opportunities as long as you know what people need in their lives. So as long as you focus on what people actually need in their lives, there's going to be a way for you to make money. So
that's right.
What's not changing? Instead of asking what is changing, ask what's not changing.
Ask what's not changing.
But one of the things that are changing right now is, and just coming back to the whole geopolitical issue, and how this may affect markets. Currently, right now, there's potential for a war to break out in Venezuela. And it seems like there is thousands of troops, kind of stationed on ships and military vessels all along the border of Venezuela. Venezuela also produces something like 18% of the world's oil. One of the largest producers in the world or not necessarily producers because they're not getting the oil out now, but they have the stockpiles of oil, right? What does that potentially do for the price of oil? And, where could that, if a war were to break out, what some analysts are saying that the price of oil could potentially go to $120, $130 a barrel. What does that then do for inflation? Are we going to start to have that inflationary conversation again all over? Where does that potentially take the global economy?
Yeah, so you're right. Venezuela actually has perhaps the largest sort of, together with Saudi Arabia, the largest proven oil reserves. And ostensibly, this is a potential conflict as a result of fentanyl and drugs, but perhaps the subtext is actually oil and resources, and of course Allah knows best. But there's a lot of posturing as well by countries even like China, for example, that have got up to $80 billion of investments in Venezuela, and that have invested significantly in Venezuela since 2007. And they have cautioned, for example, the US to not attack Venezuela, because that could, amongst other, impact Chinese investments. But if there is a conflict, that will definitely have an impact upon the oil price. Yeah. But it is less likely to be as material to the global economy than had that conflict been, say, in the Middle East. And the simple reason for that is not that the oil is anywhere less than say, the Middle East. The actual issue is that the Middle East and the Strait of Hormuz is actually one of the world's major, what they call, choke points. So a huge amount of the world's oil actually goes through that choke point. So when you think of a choke point, think of a hose pipe that gets knotted, right? No matter how powerful that hose pipe is, once it gets knotted, all of a sudden the water doesn't come out. Yeah. And that's really what that choke point is in the Middle East. Whereas the Caribbean and where Venezuela is, yes, there's a huge amount of oil there, huge amount of incentive to kind of go after that oil, but it is not a global choke point. Not only for oil, but also for trade. That, I think, is the essential difference. But one other thing that I also just wanted to just circle back on, we spoke about one of those things that don't change, and maybe I can try and make it a little bit more sort of contextual and relevant. Is we know that one of the things that don't change, and that has been around since man was mobile, right, is the need and the desire to travel. Yeah. Okay? Is the need and desire to travel. And global travel, as outside of major wars and outside of things like pandemics, actually exhibited very, very, very steady and consistent growth. Okay? So no matter how global conflicts or regional or geopolitical sort of posturing happens, we know that innate desire of human beings to travel, to see different parts of the world, will always be there. Okay. And there are stocks out there that actually focus just on travel. For example, like Booking.com, right? Everybody's used Booking.com. And actually the share price has pulled back quite a bit now, right? So this is not investment advice, but that's potentially an interesting stock at the moment, right? Guys are afraid that, Google's potentially going to challenge them, but they've been around very, very long, and they're actually well positioned. So there are opportunities that may arise despite the noise around geopolitics, countries restructuring their economic and other relationships.
So that's very interesting. I want to touch on resources, and I know we've been chatting about gold and platinum and silver lately. We're almost seeing weekly gains of nearly 10% on these materials in the short-term momentum. My question is, could this be signaling a bubble within the resource space, or is it just a healthy recovery?
Yeah. So clearly, there's going to be differences of opinion on that, right? But if you try and just zoom out, for commodities as a whole, including things like gold and platinum, but let's generalize it. For the last sort of 15, 20 years, there's been a consistent underinvestment. A consistent underinvestment in trying to find new sources of commodities, right? New reserves, put differently. And in addition to that, fewer and fewer people are going to study, number one, for example, mining engineering. fewer people want to go and prospect in remote parts of the world. Okay, everybody wants to go into finance or tech or this or that. Environmental regulations have become tougher and tougher and tougher. Okay, of course we want to look after the environment. I'm just describing the context. Yeah. That means ultimately that companies, mining companies and investors have been exceptional, and banks in fact, have been exceptionally reluctant to back new investments in resources. So now what happens is, for example, as a result of AI, the desire for clean energy, electrification of the grids all over the world, and so on, actually people realize to have all of these things, we need commodities. We need commodities. But when they look for the commodities, they can't find it because they didn't invest in it for the last 20 years. Right? So what then happens when demand hits something where there's almost very little supply, what's going to happen? It's in a sense another choke point. The price is going to be the mechanism that's going to go up, isn't it? Yeah. Because there's this huge demand, but there's very little supply. Okay, so that then causes commodity prices to go parabolic as they have or gone vertical. But despite that, for a significant amount of commodities, the current price is still below what is called the incentive price, which is simply the price by which companies and, let's broadly speaking, investors are incentivized to go and look for new commodities, right? It's still below the incentive price. So that means that for certain commodities, actually, that price has got to go higher, right? Put differently, everyone talks about AI and AI and AI, but you need copper for that. From the time that you go out looking for a copper mine to the time that it actually goes on stream and produces, can take up to 20 years. Sure. 20 years, right? That's almost a generation. And that's why the prices of commodities, copper, platinum, gold, of course gold has its own particular sort of context, but I'm generalizing, commodities have gone up, and why the outlook for a commodity-driven economy such as South Africa is inshallah, Allah knows best, positive. The outlook is positive.
You know, Salih, you mentioned AI, and I'm going to get to that. I'm going to get to the AI piece because I want us to focus a bit on AI. But before we go into that, one of the slides that you showed was also around, property for the year 2025 thus far, year to date, did 31%.
Yes.
Right. Now, when I look at property, for example, I think over the last 3 years it's been doing quite well. But prior to that,
yes,
for 5 years or so, property was flat.
Yes.
And wasn't giving any returns, and portfolio managers were looking and saying, we got this property, asset class here in our portfolios that haven't really been giving returns, and in fact, in certain cases, have been giving negative returns in certain cases. What in the property market? Because just like resources in many cases, property tends to be that kind of that steady asset class, that normally people can rely on.
Yes.
Is that the brick and mortar? You can see it, you can feel it.
Yes.
It's got the same type of feel as gold, let's say, for example. But what's the story around property, and why has it made that change over the last few years?
Yeah, you must remember the last 5 years also coincided with the COVID COVID period. And this, of course, upended all asset classes, but property in particular, because for roughly 2 years, most people were kind of 70-80% of the time at home. It was work from home. Not only were working habits essentially got re-scripted and rewritten over that time period. So, in addition to that, shopping habits also changed, right? We didn't see so many checkers 60 minutes as we have now, right? So there was a shift to online. So there was in a sense, let's call it a structural break from previous pre-COVID time period. That then had a huge impact on property rentals, property demand, etc., which then obviously caused property prices to fall, right? And caused the rentals to either stagnate or in fact, in certain instances, actually adjust downwards, because all of a sudden, buildings that were being built couldn't be filled, okay, etc., or malls as well, okay. That obviously was then reflected in the prices of property and listed property as well, okay. As we slowly came out of that time period, and things started to normalize relative to a pre-COVID period. We then found actually that property prices then started to recover, and as you've seen over the last year, gave you a return of 31%, and in fact the return for the last 3 years has been a very respectable 23%. That's been really good, and that's just of course listed property. You may have had even bigger gains in unlisted property or in other sub-segments, specialist segments of the property market.
So I wanna get into AI. It seems like AI is dominating the headlines, and companies are racing to integrate it. Investors are piling in, and people are saying if you're not all in, then you're already behind, right? But I feel like hype often comes before the heartbreak. So my question is, do you think AI is truly a revolution, or are we just buying into a very expensive story?
I think I'm going to lay claim to that statement that you had. Hype comes before the heartbreak. It's a good one.
Yeah, it is a good one.
Look, it seems that AI is, in fact, from my perspective, the real deal. It is potentially a revolutionary technology, right? Definitely seems like a revolutionary technology. That being said, corporates all over the world, not only corporates, but corporates, governments all over the world are trying to find really innovative and good use cases for the technology, and they currently are actively, as you're well aware, experimenting. They're still in the experimentation phase, and the technology is just going to get better and better, and we can see that the rate of improvement is quite significant, mashallah. Right. That being said, I spoke about a few minutes ago. I spoke about commodities as a broader sector that has essentially been starved of capital for the last, let's call it 20 years, 15 to 20 years. Been starved of capital for the last 20 years. That means as soon as there's demand, the the only mechanism that can adjust is the price because there's no supply.
Yeah.
What's now happened actually on AI, counterbalance that with what's happened on the commodity side, is that we've had $500-600 billion actually flow into AI, and more actually coming on stream over the next couple of years. That means that there is the tsunami of cash, of investments basically chasing the AI theme. And whenever you have something like that, it ultimately ends up at some point in time being very good for the end user, but not necessarily for the investor.
Okay.
Not necessarily for the investor, right? Let me give you a very, very simple example. Let's imagine, let's use a very real example. South Africa experienced load shedding a couple of years ago, right? And we had the Bucky Brigades come out, and everyone all of a sudden reinvented themselves as what? As solar panel installers, okay? And the prices that they charged was like really, really crazy. Why? Because Eskom wasn't providing any electricity. So anyone who had money, basically tried to fund or start an energy company, right? A solar energy company. So you had this flood of capital. Eventually, what happened was, after Eskom managed to switch on the lights, we found that in fact there was excess capacity, right? And all of those people who had invested in these energy companies and these solar panel companies, what happened to them? After having a little bit of abnormal profits for a year or two, their profits actually collapsed. In fact, I just heard from a solar company now the other day, up to 80% of them have been wiped out over the last 2 years. And that's what I'm saying is what's happening with AI, is that there's this huge amount of investment that is going into it. And it is ultimately, it's called the capital cycle, right? When you have all this capital chasing this opportunity, eventually what happens is that the returns to that potential opportunity comes down, right? Which is great for you and me as the consumer, right? But for the investor, it's not such a good thing. So what you want to do as an investor is not necessarily invest in the AI companies, right? But you rather want to invest in the companies that are going to use the AI, and especially if the price of that AI at some point in time, because of overcapacity potentially, is going to come down. So classical example, who sits on huge amounts of data?
Google.
Right? Okay, besides Google, as an industry, huge amount of data is, for example, the healthcare sector.
Okay.
Huge amounts of data. And we know, coming back to one of my first points, focus on those things that are not going to change. Right? People are still going to need to go and have good healthcare, right? And especially if you're someone like Haji Ali, you're going to be really looking after your health because you want to run marathons, you want to do all of these good things. You got your watch that gives you all your data, right? All of that, and the data is just increasing all the time. I check, oh no, my heart rate's a little bit low. Okay, and then immediately it's going to schedule an appointment with his physician or his physio and whatever. So the need for healthcare is always going to be there. And the amount of data because of wearable devices is just going to go up. So healthcare sector, whilst not an obvious AI play, is actually going to be a huge beneficiary of AI because they can take that data, they can take all those models, which they didn't have to invest in at such crazy prices. they can take all of that data, all of those models, they can monetize it and ultimately use it to strengthen their value proposition, to grow their revenues, or to cut their costs. So now you have the intersection of something that doesn't change with something that will change, which is AI, for example. But at the same time, it's also not the company that is spending hundreds of billions on trying to build out all these models. It says, okay, you build it, I'm just happy to use it. And then you, as an investor in that company, you benefit ultimately.
No, brilliant. Brilliant, Salih. And that's why you, Salih Salam. No, excellent. I think that's a great way of thinking of it and a great way of looking at it. Also, in terms of AI, there seems to also be a race now around, kind of these chips that are required in all of the various products that are being developed that are utilizing AI. So from a robotics perspective, we're looking at, robots now being created that are actually doing jobs. Apparently, there's a robot that is actually on the manufacturing line of for vehicles, for certain cars in China, and literally doing the work of a person. So, and for that, chips are required, these chips. And this Taiwan semiconductor company in
Yes.
Taiwan. But now I think they've developed or they are in the process of opening in Phoenix, Arizona, a plant where with Trump's encouragement,
Yes.
He wants them to now start to develop. He wants them to develop these chips within America.
Yes.
Then Elon Musk said, look, there's just not enough supply. There's just not, the demand is there. The demand is great. Again, coming back to demand and supply.
Yes.
Tesla needs to now get into the game of creating chips.
Yes.
Okay, so as an AI play, do you think that, investing in those types of companies would also do well for investors?
Yeah, you definitely want to invest in the so-called, let's call it picks and shovels, and the basic building block amongst all of that is definitely silicon and chips in particular. And in fact, TSMC perhaps is potentially the most geopolitically important company in the world. In fact, it's so important. It's so important that in Taiwan, TSMC and the technology that they have. Everyone talks about, for example, Israel's got the Iron Dome, and the US wants to build the Golden Dome. But actually, in Taiwan, they call it the silicon shield. The silicon shield. What does that mean? Because silicon is ultimately one of the key ingredients that you use to build these chips. Yeah. And because TSMC is such a systemically important company in terms of the global technology value chain, it effectively acts as a shield to Taiwan from being invaded by China, because the stakes are so high for the global technology value chain that actually acts as a shield without any missiles. Allahu Akbar. Okay, so yes, of course, there's definitely demand for that, but there are also other areas. I mean, it's not only in things like chips. I spoke to you again about copper, right? Copper, and why that's important, because South Africa as an economy, and as a country, we've got copper reserves. Other emerging markets like Peru and Chile, they've also got lots of copper. And without copper, right, well, actually the whole technology race is severely hamstrung without copper. So we have to try and look also for the non-obvious beneficiaries of this technology boom as well. And that's why we found, copper stocks across the world like Freeport in Canada, or Anglo American that bought another Canadian company called Tech Resources, because they just bought that company now quite recently, or Glencore, also going up quite significant, because these are companies that are sitting on huge amounts of proven copper reserves. And consequently, as I said, copper now all of a sudden is one of those on the critical minerals list that the US has put together. Okay? It's one of those things, the critical minerals list, copper. And I think purely because we've had this chronic underinvestment in commodities over the last 15 to 20 years, all of a sudden, you would have never have heard of things like critical minerals risk list. Countries around the world are starting to recognize, actually, guys, there's nothing that can power our desire from a technological perspective if we don't actually have access to resources, which once again, as I said, as a South African investor, ultimately acts as a nice tailwind for our economy. So whilst we don't have Google listed here and we don't have other tech companies listed here, that doesn't mean that actually from the whole value chain, when you think of the broader value chain, that actually an economy like South Africa won't necessarily benefit. In fact, we could benefit.
So I want to play devil's advocate here. Right? Say the hype fades and valuations crash. What's really left behind? With telecom, we had fiber networks that still powered the future.
Yes.
With .com, well, we mostly had broken dreams. But if AI stumbles, do we at least get something useful, or is this all intangible smoke?
Yeah, brilliant question. So in contrast to the telecommunications boom, where huge amounts of fiber was laid, and in fact, there was even a term that was called dark fiber, because the fiber needs to be lit, right? There was such amount of excess fiber that was laid that eventually, when the boom ended, those bandwidth prices collapsed dramatically. Those investors got wiped out. But over time, the fact that those prices collapsed dramatically effectively then subsidized, if you will, or caused the creation of these innovative business models like Amazon Web Services, like Google Cloud, like all these internet companies that ultimately used that bandwidth, which was essentially for free, to build these great business models and these vaunted businesses, because they didn't have to lay down the cable. Some poor sod did it before him, right? So they came in, benefited from all the dark fiber that had been laid, and essentially got it for free. Okay, which then brings me to my point. If that eventually happens, and of course Allah knows best, if that eventually happens, you want to make sure that you're not the person that is actually investing in those companies that are throwing all of these billions to build out all of these AI models and so on, right? Because they are like the telecommunications companies of past. What you want to do is you want to be the guy that says, okay, once the music stops, I can buy this thing on 5 cents in the rand or 5 cents in the dollar, and I can use that to subsidize and run my business. Okay? That's what you want. And that's why I'm saying it's far better to focus on ultimately who is the one that is going to use the model as opposed to build the model.
Oh, great. And just bringing it back to South Africa, Salih. So we saw now that Eskom for the first time, I think this year, made a profit. So they were really, like you said, really able to turn things around and turn the lights back on, right? So fantastic. We are very happy about that. And then you mentioned that South Africa has all of these, kind of resources, specifically copper. And but what I want to ask, or what I want to understand is, as a economy, pulling these resources out of the ground, are we then just, as a country, still allowing those raw materials to leave our borders? Or are we ever going to get to a point where we, kind of take it to the next step, where we actually create jobs, create opportunities, and start, manufacturing instead of just having the raw resources be exported? That's
an exceptionally important question, and I'll try and time our answer to some of the sort of geopolitical sort of shifts as well. So what you're finding is also as a result of geopolitical shifts happening is that countries are increasingly a lot more focused on what is called industrial policy, and they are actively being a lot more strategic and a lot more muscular, in a sense, on industrial policy and how that gets developed and ultimately rolled out, particularly in industries that are of strategic importance, right? Because countries are increasingly recognize, especially post-COVID, right? Post-COVID and post the start of the Russia-Ukraine war, that because of the global supply chain and global logistics, that at any point in time, whether it be as a result of a pandemic, or whether it be the result of a war, or whether it be the result that you're on the wrong side of a shifting strategic alliance, that your supply chain can be cut off. Yeah. And you can be cut off from either raw materials or ingredients for medicines or ingredients for manufacturing and so on and so forth. And consequently, as I said, countries around the world, not only in the US or China, but around the world, are increasingly looking at where are those vulnerabilities within their supply chain, especially around whether it be critical minerals or whether it be critical ingredients for the broader supply chains for that country. So as far as commodities are concerned, you are absolutely right. South Africa needs to, and inshallah is increasingly trying to not only focus on extractive industries in terms of just how those minerals and resources are extracted, but also they want to increasingly go up the value chain and beneficiate that, because ultimately that increases value. As you said, it creates employment, creates extra tax revenues. It makes us more independent and self-sufficient. So absolutely, that needs to happen.
So, what's your advice for South African investors? I mean, look, we from South Africa, we are watching the AI stocks soar while the JSE is quietly delivering strong returns, right? Should we chase the hype, stick local, or do something smarter? What's your advice for someone managing retirement savings right now?
SubhanAllah, you're asking me all these tough questions.
First, he's not allowed to give advice.
Okay. Yes, absolutely. Thank you. He's my compliance officer. My compliance officer. Alhamdulillah. So, look, you're right. Obviously, our market, by virtue of our geography, or our address in the global village has got certain characteristics, and that means, of course, as you rightly speak, we have a significant sort of bias towards commodity industries, and we don't have necessarily those direct beneficiaries like TSMC or Google or any of those stocks listed on our stock exchange. So a South African investor either has to use the offshore allowance, or platforms like Easy Equities and various others also offer opportunities to invest, in fact, in those offshore stocks. I think it's also worth remembering that the JSE, in terms of the global market capitalization, it's only about 1% of the global stock market total market value. So there's another 99% that we can invest in, and increasingly there are a range of platforms that allow the South African investors to not necessarily invest in the 99%, but inshallah it will get to that point. There are increasing opportunities to do so. I think that my opinion is that AI is definitely real, but so too is the danger of the capital cycle, which I spoke about earlier, actually causing those returns to just all come crashing down, much like we had with the dark fiber that just stayed unlit for very, very many years simply because of overinvestment. There's a very real risk of that. There's a very real risk that, in fact, China could actually potentially win the AI race because they have got a lot more things going for it. For example, their energy prices are much cheaper, their models are much cheaper, etc.
The people work 24 hours a
Their
day.
people work 24 hours a day and, in fact, sleep under the desk, right?
Yeah.
Etc. So there's a very real race, very real risk of that. But coming back to my first point that I mentioned, focus on what is not changing. Focus on who ultimately has got the great data sets that they can use to monetize, to deploy these models that somebody else is building, right, for free, effectively, as far as you are, the user, is concerned. Use those models and ultimately use AI to help grow your business, to help you as a company fulfill those needs that are not changing. That, for me, is the far more, it's like, let's use an example, it's like crossing the Sirat. Like you're trying to walk a really, really delicate path, okay, where you want to grow your capital, but you also want to preserve your capital. And those companies, those are the ones that are ultimately, no matter what happens, those are the ones that will continue to grow their profits, and because they're fulfilling real needs and they are using the technology ultimately to help fulfill those needs. And you as an investor can buy into those stocks, like I told you, for example, whether it be a Booking.com or whether it be a Garmin, right, for example, because Haji Ali wants to know his heart rate now, and so on. So that for me is how is the prudent way to potentially approach the problem. Invert it, focus what doesn't change, and then say how can those companies use AI to grow their value propositions.
Sadiq, I was going to end off now with asking you for your hot stock tip, but you already mentioned, you mentioned Eli Lilly. We know Canadian Rail or Canada Rail.
Yes.
We got Bookings.com. We've got Garmin. Okay. So we're going to exclude all four of those. And we're going to ask you, okay, so what is, besides those four, what's your hot stock tip for us?
Yeah, look, it wouldn't be. It certainly wouldn't be. Let's not say this is definitely not financial advice. And I think within the local market, within the South African market, we've really had a tale of two cities. What Charles Dickens, right? It was the best of times, it was the worst of times. The best of times was really on the gold and precious metals, which we said did 117%. The worst of times, not in absolute terms, but on a relative basis, because the rest of the market also gave really good returns, has basically been what we call South African Inc. shares, domestically focused stocks, right? Domestically focused stocks. And that could be, for example, stocks like Woolies, right? And special shout out to, for example, like actually Sheikh Mohammed West. They did some really, really good work, and they looked at that company and they worked out what was the impermissible income, what was the halal income, and what was the income actually that was coming from non-Sharia compliant food sources, and actually the non-Sharia compliant food sources was actually less than 5% of Woolies total income. But we know that me and my wife and Haji Ali, we're going to continue to go to Woolies because they sell some really good things, so they seem to real needs that are not changing, really good food. They've got some really good, they provide clothing as well, reasonably priced clothing, so those needs are not necessarily going to change. But the share price at the moment is really, really, really been under the weather, if you will. It's on sale. It's on a fire sale, the red hanger sale. Yeah. It's on fire sale because of some problems actually they've had in Australia.
So that David Jones
yes,
debacle. Yeah.
That's right. And that's actually caused the value in the domestic business to be hidden, to be masked by the challenges that they've had in the Australian business. So Woolies, and in fact our South African retailers as a whole, as a cohort, are in fact offering very interesting opportunities at the moment.
Oh, wonderful. Excellent. And just to end off, Siraj, do you have anything else you wanted to add?
Salih was brilliant as usual.
Shukran, Salih. We appreciate you. Shukran for your time. There you have it, guys. If you enjoyed this episode, please give us a thumbs up or a like. Leave a comment, hit the bell icon. We really appreciate it, and it helps the channel very much. And assalamu alaikum wa rahmatullahi wa barakatuh.